Today, we'll be defining emerging market countries and discussing the investment characteristics of the emerging markets asset class. While there's no universal definition for an emerging market country, there are some common characteristics. First, emerging market countries are generally less wealthy than developed markets, as defined by gross national income per capita, which measures the total income of a country divided by its population. Brazil, Russia, India, and China are all considered emerging market countries, as their GNI per capita is less than $15,000. To put that into perspective, the GNI per capita in the US is $58,000. Additionally, emerging market countries tend to have smaller and less developed stock and bond markets that are generally more difficult for outside investors to access. For example, Qatar is actually the fourth wealthiest country in the world in terms of GNI per capita, but is still considered emerging as its stock and bond markets are very small and difficult to access. Emerging market stocks are expected to generate higher returns than developed market stocks over the long term, given their higher economic growth potential and expectations that their stock markets will become more open to outside investors. However, with this higher expected return comes added risk, as emerging market countries have historically been prone to economic, political, and currency crises stemming from mismanagement or corrupt political, economic, and monetary policies. Furthermore, many emerging market economies are heavily dependent on external financing, such as Turkey, or commodity prices, such as Russia, which can lead to large economic boom and bust cycles based on the overall health of the global economy. In future videos, we'll discuss a few historical emerging market crises, the factors that caused them, and how these past crises have influenced our investment process. Thanks for tuning in.